All right, Yield Nerds, episode 188. Exciting times. The graphic is different. That's because I am now trying a couple of different tools to create the presentations. Still the same content. This time, I thought I would tell you about my big turn in how I am re engineering my portfolio. As you may have noticed, the market hasn't exactly been warm lately, it is cooling. So let me tell you what I'm doing. And before I go much farther, thank you for your support. 490 something subscribers. If you're new, please use the income investing roadmap. There are a handful of other, uh, you know, uh, playlists as well. But most importantly, don't take anything I say for granted. Please do your own homework. Well, I am transitioning from beta volatility into alpha advantage. And I am also making a very strong turn from risk to income. And there is a reason I'm doing it. And, I'm reading the tea leaves here. The job market is a little bit edgy. Tech is crashing. We seem to be running away from risk. And so I'm actually increasing my duration in specific areas. And if the presentation format looks different, that is because our friends at Notebook LM helped me create this from the narrative I wrote. Well, my usual disclaimers before I go further. This is not investment advice or tax advice. I am not a wealth management advisor. I don't do product politics or sell t-shirts. So let me get to it. I have my own thesis. You can have your own. I believe that for one reason or the other, Chairman Walsh will be successful in decreasing short-term interest rates. Maybe the economy crashes with the jobs report the way it is. The geopolitical tensions in the Middle East may create a bigger problem. Maybe the job market will collapse. Who knows? One way or the other, my thesis is that short-term interest rates will go down. And when that happens, the longer end of the curve sometimes holds, which means if I own longer duration bonds, they will see huge increases. And there are other times where, given the crushing debt load, you could also argue the longer end will have bear steepening. So there are two ways of reading the long end, but I am reading the short end as somehow Chairman Walsh is going to be successful. Well, I'm giving it a 50% odds. This is my thesis. If you differ from this thesis, I really want to hear from you. I want to learn. So please share that in your comments. The next most expected case from my world is unfortunately not a good one. It's called stagflation, where interest rates cannot be decreased and inflation cannot be tamed. And that is a disaster across the board. So I could own bonds, but the money that the bond pays will not go far enough because inflation will be higher. That's a terrible reality, but indeed it could happen. The third is, kumbaya, where AI solves all problems known to mankind. And we have huge increases in productivity, and we could have lower interest rates, higher productivity, full employment, no inflation. How about that? I give it a 20% chance. Maybe I'm being too optimistic, but those are the three cases, and that is my thesis, and I'm going to trade based on that. So what am I doing to my asset allocation? First, my stocks, I am adding BDCs, business development companies, but I only have 2% of them. The reason I add business development companies is because, yes, they are very risky. However, they have huge dividends. They have 12% dividends. So I'm kind of juicing up my dividend portfolio just to kind of keep that money aside while I de-risk elsewhere. My long-term agency bonds and my long-term muni bonds are illiquid. What do I mean by that? I may show a gain, I may show a loss. When I try and go sell them, I can find ways to buy more, but there are no bids to sell. Once in a while, I will see a bid to sell. However, it'll be 2-3% less than the ask, in which case it is a raw deal. So I'm not looking to dump them. So bottom line is, at least in the near term, I am stuck owning the long-term agencies and the long-term munis. However, I'm keeping them for a different reason. I'll tell you why. So what am I doing then? I am slowly but surely building a cash fortress with JAAA. JAAA is what is called a CLO, a collateralized loan obligation. It's a whole bunch of AAA debt that is held for extremely short durations, oftentimes 2 weeks, a month tops. And so the liquidity is very, very high, and you can buy and sell millions and millions of shares a day, and it doesn't fluctuate a lot, and it pays a whole lot more than the short-term T-bills. Now, why would I go there? Well, if you think the short-term T-bills are going to go down, then you might as well make 1% more than the short-term T-bills. This is variable or floating rate, so when the short-term T-bills go down, the coupon for JAAA will go down as well. However, it's higher than the short-term T-bills. So I am starting to move some stuff around. My corporate bonds, this is where there is a big difference. It used to be 9% a year ago, about 3% or 4% even 3 weeks ago. I am down to 1% corporate bonds. I've gotten rid of all the long duration corporate bonds, and I'm now focused on building my portfolio elsewhere. So what am I doing? My durations, they call this a yield barbell. So it kind of has these two anchors on the side. I would like to call it grandpa's teeth. So grandpa has teeth on both ends and a couple missing in the middle. No offense, grandpas. I will be one of you at some point anyway. But I really don't have anything between 1 and 5 year. I got some stuff at the very short end and some stuff at the very long end and nothing in between. And the reason is very simple. If there is a crash and there are lower rates for whatever reason, this is the Kevin Walsh prediction. If there is a crash or if there are lower rates, then I want to have a lot of cash to move in and swoop some of those assets. If we end up in stagflation, ouchie. If we do end up in stagflation, that's the 30% probability, then we will have a very big problem. The market will start freezing up, and I again want to have cash to come in and rescue. The long end is also covering a different world. If the short end crashes, but the long end does not crash, it will go up significantly. In that case, I want to sell it for a profit. So that is why I have a yield barbell in this scenario. This is me, you do you. But then in order to manage something like this, I needed more utilities, and so I built them around Schwab. How do I build them? Well, the first thing you do is you download your positions data on Schwab. You would go to account positions and download it. And what I wanted was a simple table that showed a list of my positions, what percent of my portfolio is each position, and do I have a gain or do I have a loss? What are the dividends? And if it is fixed income, what is the expiration or maturity date? Well, the reason this also helps is I come to you and share a screenshot here and a screenshot there. It's very cryptic, and I can be this kumbaya guru who talks about how I conquered the market. You don't have to believe me. Now I am making my portfolio public in an anonymous way. Please look for a link in the description of this YouTube. It will take you to a folder called positions. There you will find a Python script. The Python script will take that Schwab income file and it will create an anonymized version of your positions. It won't tell anybody how many positions you have, but it will tell you what percent of your portfolio that position is. Are you up? Are you down? The dividends and the maturity. And so you can take that and run it, and it will produce an output called positions, and you will be able to see what is going on. I hope you enjoy it. Well, my portfolio today is 12.9% equity, 87% fixed income. And check that out. The US Bloomberg credit, which is the corporate credit market, is crashing and burning. I got out of there before that crash, so I sold my corporate bonds at a profit. Thank you. And so my fixed income portfolio rather, is chugging along while the market is up in fire because of a lot of the stuff that's going on. And yes, the equity market is also on fire. The NASDAQ is down year to date 2%. The Russell is barely up 4%. I'm cooking at close to 11%, but every day it is indeed crashing and burning. And that is why I'm moving a lot of my portfolio. So how am I doing it? Please don't add all of these. You will get 130. Notebook LM, do your math better. This 12% is equities. And of the 88%, 30% there. So this should really be 58%. Don't blame me. Notebook LM did it. So what I'm really doing is outside of the 12% where I put money into the equities, my 88% has a 30% cash cushion. That 30% has T-bills, it has JAAA. JAAA pays 4.8% tax equivalent yield. And you can buy and sell with very little difference in the price for various reasons. And you can research JAAA if you're interested. So I'm starting to move more of my asset allocation there from the risk assets. And when I get coupons, when I get dividends, or if a bond gets called, I'm also allocating there because I want to wait for one of these rainy days and move in. Now, why do I do that? Well, here is an FHLB bond that pays 5.5%. Illinois has a 5% state tax. Because FHLB is state tax free, the tax equivalent yield of an FHLB is 5.85. When it gets called, what am I going to do? If I put it in T-bills, my yield is very low. So what I end up doing is slowly, if I don't find a different way, I end up eating a lot of that yield. And that is why I have to kind of think harder. So the way I'm doing it is I would put it in a federal tax exempt muni, but I would compute it in such a way that my tax equivalent yield is 5.85 or higher. And I would take a portion of it and put it to JAAA and a small amount into BDCs. That is how I'm allocating it. And so the reality is if I put it in long-term agencies and munis, it is frozen. There is nobody who wants to buy my positions. So I may think I'm ahead, but I really have no place to go. So the only reason I would do that, is to take the income, which I will, and the only reason I would put it in treasuries is to have fast access. However, the penalty for fast access is 2 to 3%, which is almost 50% of the total yield. And so I'm not willing to take that. And that is why I'm putting money into JAAA. Now, a couple of things. If you read the news today, there was a huge job loss report and stuff like that. If you have job losses, if you have unemployment and you have inflation, that is the road to stagflation. That is why the market is freaking out. And when the market freaks out, the cool cucumbers make money. So what I'm doing is slowly positioning myself for a mid-March Fed meeting where I believe the Fed, given all the data, will have to say, yes, there are problems with oil prices. However, the job market is starting to be very shaky, and we may have to start moving from fighting inflation to job saving. If they did that, there will be a huge bond market rally. And so I'm moving more of my stuff into long-term bonds. But I'm not doing all of it there. I am putting a bunch of it into T-bills to have liquidity and also JAAA so I can sell again but make higher yield in the meanwhile. What else am I doing? I'm cutting off some of the equities that I call zombies, the things that I've had them for a while and they haven't made profit. I take the zombie proceeds and I sometimes put it into long-term bonds, other times put it into BDCs, and yet other times put it into JAAA. And that is what I'm doing to accumulate. And so my hope is that I would get 5.5%, something like that, in tax equivalent yield. And I'm willing to hold those to maturity if I have to. So I'm really balancing between two sides, the treasuries and equities on the one hand, and the high yield on the other hand. So if there is a hard landing, my long duration bonds will have a huge upside. And if indeed there is a capital appreciation, then this will be what will save me. Now, if Chairman Wash is able to drop the front end of the curve, then that would favor the long bonds again. And if somehow, however, Chairman Wash is not able to do that, then I will still benefit with the huge JAAA in the short end. So what am I doing? I'm going towards high credit, highly liquid areas and sitting here and waiting. There is an article by Eisman about credit problems. Please read that, an incredible article. I'll post a link as well. Those kinds of things give me a lot of pause. And so I am positioning myself to what I would call a 5 to 5.5% yield floor with longer duration, while I get some popcorn and wait for the March Fed meeting. Hey, even a broken clock is right twice a day. Don't believe me? Do your own homework. Thank you.